Let me now turn to the economic projections that were submitted for this meeting by committee participants. As always, they conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the multitude of factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product rises from 1.9% this year to 2.1% in 2017 and stays close to 2% in 2018 and 2019, slightly above its estimated longer run rate. The median projection for the unemployment rate stands at 4.7% in the fourth quarter of this year. Over the next 3 years, the median unemployment rate runs at 4.5%, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.5% this year and rises to 1.9% next year and 2% in 2018 and 2019. Overall, these economic projections are very similar to those made in September. GDP growth is a touch stronger, the unemployment rate is a shade lower, and inflation beyond this year is unchanged. Returning to monetary policy, the committee judged that a modest increase in the federal funds rate is appropriate in light of the solid progress we have seen toward our goals of maximum employment and 2% inflation. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. With the federal funds rate only modestly below the neutral rate, we continue to expect that gradual increases in the federal funds rate will likely be sufficient to get to a neutral policy stance over the next few years. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises to 1.4% at the end of next year, 2.1% at the end of 2018, and 2.9% by the end of 2019. Compared with the projections made in September, the median path for the federal funds rate has been revised up just 0.25 percentage point. Only a few participants altered their estimate of the longer-run normal federal funds rate, although the median edged up to 3%. Of course, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks. As many observers have noted, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is far too early to know how these policies will unfold. Moreover, changes in fiscal policy are only one of the many factors that can influence the outlook and the appropriate course of monetary policy. In making our policy decisions, we will continue, as always, to assess economic conditions relative to our objectives of maximum employment and 2% inflation. As I've noted on previous occasions, policy is not on a preset course. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As our statement says, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.